Hey everyone, today we are going to talk about two interesting companies that are quietly making big moves in their industries. The first one is a specialty chemical company that just delivered an outstanding Q1. Profit jumped nearly 200% year on year and margin reached 24.6%. And the second company is a tech solutions player that more than doubled its revenue and profit, and now with rising start infra demand and a shift to recurring revenue, it's aiming for rupees 1000 crore top line growth. So basically, both companies are expanding steadily. One is scaling up through high margin chemical exports and new verticals, and the other one through a tech first transformation and recurring revenue. Welcome to another episode of Noisemaker, where we keep things simple and talk about companies that may not always be in the spotlight but have a strong potential for the future. I am Nishant, equity research analyst at Desvelado Advisory, and today we are going to talk about two companies that are making solid progress in their business, and if current trends continue, they might keep growing even further. But before we begin, here is a quick disclaimer. Any discussion, facts, or writing provided are for informational purposes only and do not constitute a buy or sell recommendation. Please conduct your own due diligence before making any investment decision. So let's start with our first company, Aequitas Chemicals Limited. They are an R&D led manufacturer of specialty chemicals, producing advanced pharma intermediates, APIs for new chemical entities, and materials for agrochemicals and fine chemicals. Basically, company has posted Q1 results that has been a strong quarter for them. Revenue rose 17.3% year on year to rupees 207.2 crore, largely driven by the pharmaceutical intermediate segment. A gross margin, on the other hand, expanded to 53.2%, while EBITDA grew 72.4% year on year to 50.9 crore. That pushed EBITDA margins up to 24.6%. Net profit, on the other hand, came in at rupees 44 crore. That's a 199.6% year on year increase, with a solid 21.2% net margin. Exports contributed 60% of the revenue, and interestingly, they have entered a joint venture in South Korea to expand into semiconductors and battery chemicals. So Dipali will take it from here. So Dipali, do you think this shift toward tech-driven chemistries could help them reposition in high-value markets?
Good question, Nishant. I think it absolutely has potential. Moving into semiconductor and battery chemicals through a JV in South Korea shows they are looking beyond pharma and agro. They are targeting structural growth drivers. It also aligns with the global pivot toward clean energy and advanced electronics. But what strengthens the story is their margin profile. 24.6% EBITDA margin suggests they are already in high value segments. Plus, they have maintained a 25% revenue growth guidance for FY26, backed by CDMO contracts, recent PMDA approvals, and a growing export base. Let's zoom out for a second. If we look at FY25, revenue grew 40.3% year on year to 1006.8 crore. EBITDA more than doubled to 232.1 crore, and net profit tripled to 160.4 crore. That kind of scale up adds a lot of credibility. But Nishant, how do you see this momentum translating into their new investments and diversification plans?
Yeah, absolutely, Diwali. What stands out is how deliberate they have been with capital allocation. For FY26, they have planned rupees 200 crore approximately investment focused on expanding capacity, setting up a pilot plant, and pushing into renewable energy. That's coming on the top of an ongoing rupees 310 crore capex at their Ankleshwar site. And they are not just expanding blindly; they are being efficient. Their 10.8 megawatt solar power plant is already generating approximately rupees 16 to 18 crore in annual cost savings, which helps fund these investments without hurting margins. On the business side, if I talk, they are actively scaling two verticals: battery chemicals and semiconductor materials. Commercial production of electrolyte additives is also expected in the second half of FY26. Plus, they have already received product approvals from six semiconductor clients across Asia. That's an important validation, I think. So here is what I am thinking, with export scaling and new verticals coming online, Dipali, do you think they can maintain profitability while entering such technically complex markets?
That's the key question, Nishan. And I think they're setting themselves up quite well. The combination of a margin expansion, capex discipline, and early traction in high value segments gives them a strong starting position. The ramp up in semiconductors and battery materials won't be overnight, but they've already laid the groundwork. Customer approvals, commercial timelines, and operational readiness are falling into places. They are not overstretching. They are building a profitable basis while entering next gen sectors. If they can manage execution and keep their cost base lean, this could be a meaningful second growth engine. So, to sum up, Equitas Chemicals is evolving fast. Strong core growth for pharma intermediaries and exports. Strategic entry into semiconductors and battery chemicals. Well planned, self funded capex cycle with solar savings. Signs of disciplined execution and early customer validation. So, if they stay focused and deliver on execution, they could move from being a niche specialty player to a serious contender in tech oriented chemical manufacturing.
Yeah, absolutely, totally agreed. Now, let's move to the second company that we are covering today, Synthesis Tech Limited, which provides enterprise, geospatial, and engineering services along with software sales and electricity distribution. Basically, the company has also posted a Q1 result, and that has been a big one for them. Revenue jumped 112% year on year to rupees 156.6 crore, and net profit also rose 166% to rupees 31.6 crore. EBITDA was also up 130% at rupees 30.3 crore. Here is what really changed, and tech-led services of the company now make up 51% of total revenue compared to just 24% a year ago. That tells us the company is gradually shifting away from one-time projects and moving toward recurring IP-based offerings. They have also infused rupees 50 lakh into their subsidiary ADCC Infocom to enhance software and data engineering capabilities. On the top of that, they are also targeting a quarterly order book of rupees 300 to 400 crore while also working to improve execution speed and margins. So Dipali, with this kind of shift to a digital first revenue and recurring income, do you think they have hit an inflection point in their business model?
Great question, Nishant. And I do think it's an inflection point when more than half of your revenue starts coming from tech services, especially recurring ones. You're building a much more scalable and predictable business. We're also increasing in the increasing presence in smart water and renewable energy, both of which are aligned with India's infrastructure and sustainability roadmap. These areas not only offer long-term demand but also allow for higher value solutions. Financially, in FY25 shows how far they have come. Revenue grew 65.3% year on year to 418.1 crore. EBITDA nearly doubled to 77.9 crore, and net profit jumped to 63.2 crore. Margins remained steady even with scale. EBITDA at 18.6% and net profit at 14.7%. But what I'm curious about, Nishant, is whether this strong basis give them enough operating leverage to pursue their ambitious 1,000 crore revenue goal.
I think that's a key question, Dipali, and it's look like they are being quite strategic about it. They have already started investing in scale and not just organically. They have entered the US geospatial market by acquiring VTS, a company with expertise in 3D scanning and digital twin solutions. This gives them a foothold in US federal and private infrastructure contracts, and they are also backing it with an additional rupees 12 crore investment in business development. And this isn't the only move. They have also got rupees 150 crore in surplus capital, which they are using to pursue targeted acquisitions, some of which are already in advanced stages. These are not just bolt-ons for revenue. They are aiming to bring in new customer bases and niche capabilities. So Dipali, with the right acquisitions and international expansion, do you think they can maintain margins while scaling into new markets going forward? That's exactly where execution will matter most, Nishant. But far, they have been disciplined. Margins have held steady despite the rapid top line growth, which tells us they're not compromising on profitability. The entry into the US via VTS gives them domain capability and client access in a mature market. That's just not expansion, it's strategic positioning, and the 150 crore reserve gives them room to move fast when opportunities arises. The real challenge is ensuring that each new vertical, whether smart infra, renewables, or US geospatial, aligns with their core strengths in tech and engineering services. If they can keep that synergy, the model becomes repeatable. So, to sum up, Senses Tech is clearly in transformation mode, explosive growth in tech-led
recurring revenue, expanding into infrastructure linked verticals like smart water and renewable, strategic US market entry with 3D tech capabilities, targeted M&A backed by healthy capital reserves. If they continue executive with discipline, they could evolve into a full stack digital infra solution provider with high visibility, diversified revenue, and long term margin sustainability.
Yeah, thanks a lot, Dipali, and that really helped us understand the direction of both these companies are moving in. All right, so let's take a look at how some of our previous picks that have performed. Nova Aggregate Limited, we picked this up at 49.5, is now at 56.2, giving a return of 11.9%. GMM Pflauder from 127.4 to 1350, that's a gain of 6.1%. Orena Power Limited, it's moved from 2190 to 2090, giving a negative return of 4.5%. Pars Defense and Space Technologies Limited, this one also saw a dip from 818.9 to 674.9, which is a 17.5% decline. Gabriel India Limited, we picked this at 842, is now currently trading at rupees 1010, giving a return of 19.9%. So overall, a pretty good mix of gains, and we will continue to monitor all these companies closely to see how they shape up in the coming quarters. So as you can see on the screen here, it is a QR for your reference purpose to get all the companies that we have covered in the Noisemaker segment and how they have performed till now from the date that we have covered. So you can just scan the QR and get all the companies data. So let's look at the summaries of today's recent filing. Acutaas Chemicals Limited company delivered a strong Q1 FY26 performance with revenue rising 17.3% year-on-year to rupees 207.2 crore. EBITDA also grew 72.4% year-on-year. On the other hand, Synthesis Tech Limited that we covered, the second company, the company has also delivered a strong Q1 FY26 with revenue up 112% year-on-year to 156.6 crore. PAT up 166% to rupees 31.6 crore and EBITDA rising 130% to rupees 30.3 crore. So that's it for today's edition of Noisemaker. If you found this breakdown informative, you can scan the QR to read the full report, and we will be back soon with more simple and clear market updates. Until then, stay curious, stay informed, and stay ahead.